Stock market analysis, April 11, 2025. As of April 11, 2025, global stock markets are experiencing extreme volatility driven primarily by escalating trade tensions between the United States and China. The past week has seen dramatic swings in major indices, with historic rallies followed by sharp sell-offs as investors react to rapidly changing trade policies under the Trump administration. The current market environment is characterized by heightened uncertainty, elevated volatility measures, and significant sector rotations as investors recalibrate their strategies in response to the evolving economic landscape. Major indices. As of the market close on April 10, 2025, the major U.S. indices showed significant declines. Dow Jones Industrial Average closed at 39,593.66, down 1,014.79 points, minus 2.50%. S&P 500 closed at 5,268.05, down 188.85 points, minus 3.46%. Nasdaq Composite closed at 16,387.31, down 737.66 points, minus 4.31%. These sharp declines followed an extraordinary rally on April 9, when the Dow surged by nearly 3,000 points, its largest single-day gain in history, after President Trump announced a 90-day pause on his broader tariff implementation plan. However, markets reversed course dramatically the following day when the White House clarified that while tariffs on most trading partners would be reduced to 10% for 90 days, China would face a massive 145% tariff rate, combining the new 125% tariff with existing 20% duties. Year-to-date performance. The major indices have experienced significant declines so far in 2025. Dow Jones, down approximately 4.6% year-to-date. S&P 500, down approximately 7.2% year-to-date. Nasdaq Composite, down approximately 11.3% year-to-date, making it the worst performer among the major indices. This performance represents a stark contrast to the bullish sentiment that dominated markets in late 2024, with the S&P 500 having fallen approximately 18% from its all-time high reached less than 2 months ago. The U.S.-China trade war, catalyst for market turbulence. Recent developments. The primary driver of current market volatility is the escalating trade war between the United States and China. Key developments include: April 9, 2025, President Trump announced a 90-day pause on most tariff implementations, triggering a historic market rally with the Dow gaining nearly 3,000 points. April 10, 2025, the White House clarified that while most countries would benefit from reduced 10% tariffs during the 90-day period, China would face a substantial 125% tariff, bringing the total to 145% when combined with existing 20% duties. This announcement sent markets into a tailspin. April 11, 2025, today China has responded by raising tariffs on U.S. goods to 125%, further escalating tensions and contributing to market uncertainty. Market impact. The trade war has introduced significant uncertainty into global markets, affecting various aspects of the economy. Supply chain disruptions. Companies with complex global supply chains are facing increased costs and logistical challenges. Inflation concerns. Higher tariffs are expected to contribute to inflationary pressures as import costs rise. Currency volatility. The U.S. dollar has weakened against major currencies as investors reassess the economic impact of trade barriers. Corporate earnings outlook. Full-year 2025 corporate profits for the S&P 500 are now projected to rise by 9.4%, down from the 12.5% forecast made in early January 2025. As one analyst at Atlantic Council noted, China is ready to eat bitterness in the trade war, raising questions about whether American consumers and businesses are equally prepared for potential economic pain. Atlantic Council. Sector performance and analysis. Technology sector. The technology sector has been hit particularly hard during recent market turbulence. The Nasdaq's 10.4% decline in Q1 2025 was just the beginning of a challenging period for tech stocks. The Magnificent Seven stocks have experienced significant declines year-to-date. Apple, AAPL, minus 13.0%. Microsoft, MSFT, minus 10.1%. NVIDIA, NVDA, minus 18.3%. Meta Platforms, Meta minus 1.5%. Tesla, TSLA, trading at $252.40 as of April 10th, down 38% year-to-date. Apple stock has shown extreme volatility in recent days, jumping 15.64% on April 9th following the initial tariff pause announcement, only to give back some gains the following day. The stock closed at $190.42 on April 10th, reflecting investor concerns about Apple's significant exposure to China for both manufacturing and sales. CNBC. Similarly, Tesla experienced its second-largest daily gain in history on April 9th, soaring 21.14%, but retreated 2.92% the following day as investors digested the implications of higher tariffs on its global operations. Energy sector. In contrast to the broader market decline, the energy sector has shown resilience. The energy sector is up more than 10% year-to-date as of early April 2025, making it one of the few bright spots in an otherwise challenging market environment. Rising natural gas prices have contributed to the sector's outperformance. Top performers in the energy sector include EQT Corporation, EQT plus 15.9%. Chevron CVX, plus 15.5%. Devon Energy, DVN plus 14.3%. Coterra Energy, CTRA plus 13.2%. This sector rotation into energy represents a significant shift in market dynamics, as investors seek refuge in areas of the market less exposed to direct impacts from trade tensions. U.S. Bank. Financial sector. The financial sector is closely watched as banks begin reporting Q1 2025 earnings. J.P. Morgan Chase, JPM, is scheduled to report first quarter results on April 11, 2025, with analysts expecting earnings, $4.61 per share. Revenue, $44.11 billion. J.P. Morgan stock closed at $227.11 on April 10th, down 1.26% for the day but showing relative resilience compared to the broader market decline. The financial sector's performance will be crucial in determining whether the market can find support at current levels. CNBC. Similarly, Tesla experienced its second-largest daily gain in history on April 9th, soaring 21.14%. But retreated 2.92% the following day as investors digested the implications of higher tariffs on its global operations. Energy sector. In contrast to the broader market decline, the energy sector has shown resilience. The energy sector is up more than 10% year-to-date as of early April 2025, making it one of the few bright spots in an otherwise challenging market environment. Rising natural gas prices have contributed to the sector's outperformance. Top performers in the energy sector include EQT Corporation, EQT plus 15.9%. Chevron CVX, plus 15.5%. Devon Energy, DVN plus 14.3%. Coterra Energy, CTRA plus 13.2%. This sector rotation into energy represents a significant shift in market dynamics, as investors seek refuge in areas of the market less exposed to direct impacts from trade tensions. U.S. Bank. Financial sector. The financial sector is closely watched as banks begin reporting Q1 2025 earnings. J.P. Morgan Chase, JPM, is scheduled to report first quarter results on April 11, 2025, with analysts expecting earnings, $4.61 per share. Revenue, $44.11 billion. J.P. Morgan stock closed at $227.11 on April 10th, down 1.26% for the day but showing relative resilience compared to the broader market decline. The financial sector's performance will be crucial in determining whether the market can find support at current levels. CNBC. Market volatility and investor sentiment. VIX Volatility Index. The CBOE Volatility Index, VIX, often referred to as the market's fear gauge, has surged amid the recent market turmoil. The VIX closed at 40.72 on April 10, up 21.12% from the previous day. The index had soared to over 50 earlier in the week, indicating extreme market stress. For context, a VIX reading above 30 generally signals significant market anxiety. This elevated level of volatility reflects the market's struggle to price and the economic implications of the escalating trade war. According to Bloomberg, the VIX surge indicates panic as stock rout accelerates globally. Bloomberg. Investor positioning. Institutional investors have adjusted their positioning in response to the market volatility. Defensive sectors, increased allocations to utilities, consumer staples, and healthcare as investors seek stability. Cash levels, fund managers have raised cash levels to the highest since the 2020 pandemic. Fixed income, bond yields have risen amid a manic bond sell-off, complicating the traditional safe haven status of government debt. Gold, as a traditional store of value during times of uncertainty, gold has powered higher as equity markets tumble. Economic implications and outlook. Inflation concerns. The market is closely watching for potential inflationary pressures stemming from higher tariffs. Consumer Price Index, CPI, data is being monitored for signs that tariffs are feeding through to consumer prices. The Federal Reserve's forecast for personal consumption expenditures, PCE, inflation has been revised upward. PCE forecast of 3.3% in 2025, up from prior forecast of 2.4%. Core PCE forecast of 2.6% in 2026, up from prior forecast of 1.9%. These elevated inflation expectations may limit the Federal Reserve's ability to provide monetary policy support if economic conditions deteriorate further. Corporate earnings outlook. First quarter earnings season kicks off on April 11th with major financial institutions including J.P. Morgan Chase, Wells Fargo, and BlackRock reporting results. Analysts will be closely watching for trade war impact, management commentary on how tariffs are affecting operations and supply chains, margin pressure, evidence of inflation in input costs and ability to pass through to customers. Forward guidance, revisions to full-year outlooks given the changing economic landscape. Full-year 2025 corporate profits for the S&P 500 are now projected to rise by 9.4%, down significantly from the 12.5% forecast in early January. Further downward revisions are possible as companies assess the impact of higher tariffs. Nasdaq. Global market perspective. The trade war's impact extends beyond U.S. borders, affecting global markets. Asia-Pacific markets. Asian markets have been particularly vulnerable to trade war developments. Chinese stocks have faced significant pressure as the target of U.S. tariffs. Regional manufacturing hubs like South Korea and Taiwan are exposed through supply chain linkages. The Nikkei and Hang Seng indices have declined in sympathy with U.S. markets. European markets. European markets have shown relative resilience but remain vulnerable. The Stoxx Europe 600 fell 0.3% as of April 11 morning trading. European companies with significant U.S. or Chinese exposure face uncertain prospects. The European Central Bank's policy options may be constrained if global trade tensions further dampen economic growth. Emerging markets. Emerging markets face a complex environment. Dollar weakness provides some relief for dollar-denominated debt. However, global growth concerns outweigh currency benefits. Countries with strong trade ties to China face particular challenges. Investment strategies in the current environment. Defensive positioning. Given the heightened uncertainty, many investment professionals are recommending defensive strategies. Quality over growth, focus on companies with strong balance sheets, stable cash flows, and defensible market positions. Sector allocation, overweight sectors with less direct exposure to tariffs and trade disruptions, such as utilities, healthcare, and certain segments of energy. Geographic diversification, reduce concentration in markets directly impacted by the U.S.-China trade war. Volatility management. Consider strategies designed to benefit from or hedge against continued market volatility. Opportunities amid volatility. Despite the challenging environment, selective opportunities exist. Valuation dislocations. Some high-quality companies are trading at their most attractive valuations in years. Energy sector. Continued outperformance potential given supply constraints and relative insulation from trade tensions. Financial sector. Banks may benefit from higher net interest margins if inflation expectations remain elevated. Domestic-focused companies. Businesses with primarily domestic operations face less direct exposure to trade disruptions. As J.P. Morgan noted in their Q1 2025 investment review, the current market environment is characterized by rotation and consolidation as investors recalibrate portfolio allocations. J.P. Morgan Private Bank. Looking ahead, key factors to watch. Trade war developments. The most immediate catalyst for market direction will be developments in the U.S.-China trade relationship. Potential negotiations or further escalation. Implementation details of the announced tariffs. Industry-specific exemptions or carve-outs. Economic data. Key economic indicators will provide insight into the real economic impact of trade tensions. Inflation measures, CPI, PPI, PCE. Manufacturing and services PMIs. Employment data. Consumer sentiment and spending. Federal Reserve response. The Federal Reserve's reaction to evolving economic conditions will be crucial. Communication regarding inflation expectations. Forward guidance on monetary policy path. Balance between inflation concerns and growth risks. Q1 2025 earnings season. Corporate results and guidance will provide ground truth on economic impacts. First quarter results beginning with financial institutions on April 11th. Management commentary on trade war effects. Revised guidance for full year 2025. Historical context. April historically tends to be a strong month for markets, with an average return of 1.6% since 1945. However, the current trade tensions have disrupted this seasonal pattern, highlighting the exceptional nature of the current market environment. Nasdaq. Conclusion. The stock market on April 11, 2025, stands at a pivotal juncture as investors navigate the most significant trade conflict between the world's two largest economies in recent history. The extreme volatility of the past week, featuring both the largest single-day gain and substantial losses, underscores the market's sensitivity to trade policy developments. While the energy sector has demonstrated resilience and certain defensive sectors offer relative stability, the broader market faces significant headwinds from trade tensions, elevated inflation expectations, and uncertain corporate earnings trajectories. The coming weeks will be critical in determining whether the current pullback represents a buying opportunity in an ongoing bull market or the beginning of a more prolonged market correction. Investors should maintain discipline while remaining alert to rapidly changing market conditions. Diversification, quality focus, and selective opportunism may help navigate this challenging environment while positioning portfolios for eventual market stabilization. As Warren Buffett famously advised, be fearful when others are greedy, and greedy when others are fearful. The current market environment certainly qualifies as fearful, potentially creating opportunities for long-term investors with the discipline to look beyond short-term volatility.